and welcome to a special edition of Indianomics. Donald Trump has stormed back to power, and one of his key promises is to cut down income tax sharply and fund the budget with higher tariffs. Trump's victory sent Asian currencies from the renminbi to yen to baht hurtling down by 1.5 to 2.2 percentage points this week. So, what's in store for Asia and for the Indian economy? I'll be speaking to two economists who specialize on Asia, India and China. First up, let me invite Eswar Prasad, Professor of International Trade Policy at Cornell University. Well, in a bit, we will be speaking to Jahangir Aziz, the emerging market economist from JPMorgan. But first, let me welcome Dr. Prasad. Sir, thank you very much for finding time for us. Well, let me start by asking you, should we expect, like 1 year from now, 12 months from today, do you think there could be a lot of chaos in the international trade with tariffs and counter-tariffs?
Chaos is certainly the phrase of the hour, Latha. There is going to be a lot of unpredictability in U.S. policy making. One question is whether many of the campaign promises that Trump made over the last year or so are going to be translated into policy actions, or if these are to be seen as threats that essentially bring other countries to the table and play the way Donald Trump wants them to play. He certainly made a strong commitment to increase tariffs across the board, and especially to increase tariffs to a very high level against China. Now, I suspect we will see at least some movement on tariffs. Now, whether he's going to raise them to the extent he's talked about, whether these are going to be across the board remains to be seen. But it certainly creates a lot of uncertainty among U.S. trading partners and for the global trading system more broadly, because Trump's moves, even if they don't turn out to be very significant tariff increases, are going to put a crimp on world trade and could lead us to a place where we have protectionist moves beginning to emerge around the world.
What's your base case in terms of a Chinese response? The market is clearly guessing that China will depreciate its currency to account for at least part of the tariffs increasing prices of their products. Do you think that that will be China's reply?
Now, the Chinese economy is in a very difficult position now relative to the previous time Trump was in office and we had similar issues on the table. Right now, the Chinese economy is not doing terribly well. And over the last couple of years in the post-COVID period, one of the key drivers of growth in China has been investment. Domestic demand, especially household demand, has been relatively weak. So we have a bit of an imbalance between the increase in supply and weak demand. So China has been relying on exports to a good deal to power its growth. So tariffs at a time like this that limit exports to one of the key export markets could be important. Now, having said that, the U.S. has become a less important export market for China over time, at least directly, although there are some exports going through Mexico and Vietnam to get around some restrictions on Chinese direct exports to the U.S. So it's not as important as it used to be, but at a time when the Chinese economy is vulnerable, this certainly is a concern. So we're going to see a series of policy responses from China. I think the currency is one that they cannot use to a great extent because there is a risk that if they do start a cycle of currency depreciation, at a time when their economy is weak and confidence is weak, you could see a large surge of capital outflows that becomes very difficult to manage if that sets off a capital outflow currency depreciation spiral. But certainly a little bit of currency depreciation will help. But I think we will see a significant amount of stimulus from the Chinese government. We've already seen a number of measures to ease monetary policy, cutting interest rates, making credit more widely available. And I suspect that is going to be supplemented with a significant amount of fiscal stimulus to prop up the economy.
Okay. Well, let me come back to the U.S. economy and then ask questions on Asia. The way the markets have, pushed up U.S. stocks, it is betting on very good growth in the U.S. itself, probably because of lower taxes, a higher fiscal deficit, both of which are, growth stimulating. So do you think in calendar 2025 itself, growth may be good in the US? Is that a bet to take?
The US economy has proved pretty robust over the last few quarters, despite interest rates being held at fairly high levels until this past summer. And that momentum is likely to continue. The US is somewhat insulated from what happens in the rest of the world, so it can power itself along. And certainly some of the measures that Trump has talked about, which are likely to widen the deficit, will have a short-term stimulative effect. One of the reasons I think we are seeing stock markets in particular doing so well is not just a bet on growth, but also a bet on a much looser regulatory environment, which could be very good for corporate earnings. So that, I think, is one of the reasons why, independent of what happens in terms of growth, stock markets have really gotten a boost from this election outcome. Now, having said that, I think the fundamental strengths of the US economy are likely to remain. And if we move to an environment where interest rates are lower, where there is some fiscal stimulus along the pipeline, and we switch to a looser regulatory environment, certainly in the short run, that is all going to be good for growth.
Okay, yeah, you emphasize short run, and I thank you for that, because that leads to the next question. In the medium term, the fiscal deficit is already very high. I mean, ranging over 6%. We already saw that bond yields, despite the Fed cutting rates by a huge 50 bips in the first shot, bond yields have gone up like 60, 70 basis points, simply because of the feared supply of bonds. This looks a little contradictory to me. If the sovereign paper is going towards 4.5, as fiscal deficit increases, wouldn't that be anti-growth? Wouldn't that hurt growth?
I think the long-term interest rates in the US, especially the 10-year Treasury security, which you alluded to, is certainly hinting that there are significant fiscal problems ahead. Neither of the two campaigns, made any pretense of trying to rein in the fiscal deficit. And certainly much of what Trump has talked about is really going to expand the deficit very significantly. And it's very hard for bond markets to ignore that, even if short-term rates are coming down. We have other phenomena in play, of course. The Fed has been trying to slowly reduce the holdings of Treasury securities on its balance sheet, which is going to, again, reduce the demand for Treasuries. Now, one of the interesting questions is whether, given that we are moving to an environment where there is going to be much more volatility and unpredictability of US policies, which affects the US and the rest of the world, whether that is going to lead to an increased demand for safe assets. And of course, when the world looks for safety, it usually turns to US Treasury securities, which could help in keeping down rates at the long end of the yield curve. But it's hard to believe that with US deficits continuing to rise, even at a time when the economy is doing so well, that this will not have a significant implication on long-term rates. And that could certainly affect capital allocation in the economy and therefore long-term productivity and growth. But again, set against that is the fact that the US has had a bit of a productivity boomlet in the last few quarters, unlike in much of the rest of the world where productivity has been weak. We don't have a good sense, again, of why this is happening. People have talked about AI and other technology-related issues boosting productivity. But whatever the cause, the US has not done too badly in terms of productivity. So you could have a situation where rates, especially at the long end, remain somewhat elevated, but still the US is able to generate good growth because of good productivity growth.
Okay, you're giving us more reasons for US exceptionalism, actually. Now, let me come back to trade. Do you see global trade and therefore global growth getting impacted because of the impending war? If yes, by when do you think these reverses might hit?
We are certainly moving into an era where there is going to be a much more aggressive use of trade protectionism. It's hard to imagine that the US is going to take action just against China. Trump has this view that any country with which the US runs a trade deficit needs to fix its trade policies and is playing unfair. And this is going to have broad repercussions around the world, because if the US starts raising tariffs, other countries are likely to respond with similar measures. So we could see a wave of protectionism around the world. Again, what remains to be seen is whether the very real threat of significant tariffs being imposed by the US causes China, causes Europe and other trading partners of the US to start taking measures to basically make Trump happier, maybe with China buying more soybeans, agreeing to accept more goods from the US, agreeing to make its markets more open and so on. So we could see implications not just for trade policy, but across a broad range of policies. But for private businesses, which are really the key drivers of global integration, this is a period of elevated risks, geopolitical risks, risks of protectionism. So I think we are going to see a response in terms of channeling trade and investment flows towards countries that are more geopolitically aligned with each other. So for US investments, this might mean less money in China, perhaps more money coming towards India and many advanced Western economies, while China tries to look for export markets in the rest of the world. So we are definitely going to see a rejiggering of trade and investment patterns. This may not necessarily mean a substantial decline in global trade and investment flows, but certainly a reorientation is in prospect.
Okay, that looks like India could be the beneficiary. But, there is another point of view that keeps coming from the market, that Trump in the past has tried to shout down the Fed into cutting rates, or shout down trading partners and trying to keep the dollar from becoming too strong. You think the US can get away with that, keeping yields low simply because the president wants it or demands it? Or do you think that has its limits?
There is certainly a limit to what a president can do, but this particular president is certainly going to take a much more aggressive approach to what he thinks is right for the economy. Now, he's talked actually about weakening the dollar so that other countries don't have a competitive advantage that results from a strong dollar when their currencies are weak. But interestingly, if he did move forward with tariffs, that is certainly going to have an impact in terms of reducing the US trade deficit, and will almost certainly lead to an increase in the value of the dollar, which is probably not what he wants. The Fed is another issue altogether. I think there is a real concern that Trump could appoint people to the Fed who are seen as working at his bidding. Now, the Fed's independence has been really crucial for its effectiveness, for its credibility and legitimacy. And if we move to an era where the Fed is seen as taking orders from the political masters, especially from the White House, in the short run, that may not have a huge effect, but in times of peril, when the Fed's credibility really becomes the only thing standing between, a financial market disaster and stability, that could become a real problem. So you spoke about long-term issues. That is one I really worry about, the erosion of the Fed's independence and credibility.
Oh, that's a serious one. Dr. Prasad, we have to wind up. But can you tell us, what is in it for India? At the end of it, do you think we are going to see a continually depreciating currency because we have to compete with a Chinese depreciation? Will we be beneficiaries of this likely impending trade war? Just your last word on India.
I hope that there will be opportunity for India amid all this chaos and turmoil. Certainly, India is seen as a country much more aligned with the US in terms of economic and geopolitical interests. So there is certainly an opportunity, but it will take some very careful nurturing of the relationship between Modi and Trump, who seem to have hit it off during his previous term. So I hope that that can continue and that India can benefit from more trade and investment coming towards it.
One more. There is Trump is seen as a war dove, even if he's a tariff hawk. The expectation somehow in the markets is that he will be able to put out all the fires. Would you think that therefore we are in for at least lower crude prices because he will settle the Ukraine war probably one way or the other, as well as the Red Sea problem?
Now, certainly, I think we are in an era where Trump has very specific views about how those geopolitical conflicts need to be settled. And it's certainly not necessarily the best outcomes for the world, but we could certainly see some pressure from him on the relevant parties to put out those fires as you described them. And that is at some level going to lead to a little more peace around the world, but at a cost in terms of volatility of policies. But that could certainly take some edge off crude oil and energy prices more broadly, especially if the US also goes ahead with substantially increasing energy production here.
Okay, we'll have to leave it at that because we're out of time, but there are so many subtopics over here and we will pull them later at a later date. Thank you very much indeed for joining us, Dr. Prasad.
It was my pleasure, Latha. Thank you.
So the key takeaways, we may actually see good US growth, especially given the recent productivity increases in that country. The increase in fiscal, the reduction of taxes, increase in fiscal deficit can actually be growth supportive. And Dr. Prasad doesn't think that overall volume of trade needs to fall globally. It may only get rerouted. The big worry is that the Fed's independence could be challenged. We have to take a break on that note. After that, we're going to come back with another economist, JPMorgan's Jahangir Aziz, to continue with this discussion.